Okay, so I realized, I know many of you are familiar with Open Sky Policy Institute, but I didn't share who we are for those of you who aren't familiar with Open Sky Policy Institute. So I figured I should probably do that today. We are a nonpartisan organization. Our board of directors is nonpartisan. We have Republicans, Democrats, Independents on our board. We focus on budget and tax policy and education finance. Medicaid is a big part of the budget. So within the last year, we started working on Medicaid. And as I mentioned, we've been working on things such as unemployment as the pandemic is hit. And so what we do is we want to make sure that our policymakers have access to good data and can make informed choices. So we really want to be seen as a resource to all of you, and we work with media and other stakeholders to make sure that the decisions are being made grounded in data. So as I said, I'm going to do a quick budget review, and I'm going to talk about some tax basics and how we compare, and then some current policy issues. Some of these slides I'm going to go through really quick because I just want to make a singular point on them. But if you have something, if you want to stop me because you are interested in something else on that slide, just please let me know. So Tom talked about the budget yesterday, and I wanted to share that with you as a pie chart. And this is, anytime we're talking tax policy, we show this chart because we think it's really important that we connect the revenue that we raise to how that revenue is spent. So this is the general fund appropriations budget. This is the discretionary part of the budget. So when the legislature is having to make cuts, as likely will have to happen next legislative session, these are the areas. This is the discretionary part of the budget. So you can see here that 45% of the general fund appropriations budget goes to education, 37% goes to health and human services, and then you have another 11% that goes to public safety and law enforcement, and that's where corrections would be, for example, and would make up about half of that. So when you combine these three areas, education, health and human services, and public safety and law enforcement, that's 93% of the general fund budget, okay? So I wanted to show you this because I really want to show what happened in the Great Recession. When we look at general fund appropriations spending as a share of the economy, and we look as a share of the economy because it costs more to do the same thing year over year due to inflation, right? But you can see here that our appropriations declined significantly as a result of the Great Recession. And what I think is important to note, and I mentioned it yesterday, but in FY09, you can see there, we actually had a slight uptick. ARA funds helped bolster the budget, but then we had huge declines over the next couple of years. And so we think it's important that as we're thinking about this pandemic, that there are several factors that we can talk about as we go that actually may delay the impact on state revenue. So we're not seeing that impact to state revenue immediately because there is a lag in sales tax collections. There is a lag in income taxes, right? 2020 income taxes are paid in 2021. So we're likely to see those depressed income taxes next year, not this year. There's also that delay on sales tax collections. So what we think is really important to note is that during the Great Recession, which many economists are saying, you know, this is going to be worse financially than the Great Recession, that those declines in revenue took place over 2 biennia. So it wasn't just the current, you know, the first fiscal year that was impacted, but 4 fiscal years. So I wanted to show that to you. And again, when we look at that Great Recession, that top line is K-12 education. Again, there was a bit of a bump from the ARA funds, but then a decline. after that point. And Connie is going to talk more about K-12 education, but the way our funding formula works, when we reduce funding at the state level for K-12 education, we push that back on the local level and expect property taxes to pick up a bigger share of that. And so there is that really tight correlation there. Higher education is this blue line, and you can see that declined slightly during the Great Recession. Health and Human Services went up because there was increased demand on health and human services. Medicaid and CHIP went down, and demand went up, but the federal government provided more funding. And so the state appropriations were able to go down as federal funding went up, even though, so there was increased demand in health and human services, but the state had to pick up non-Medicaid and the federal government helped pick up Medicaid. Public safety and law enforcement has been pretty flat, but you can see here, just about the time that Doug started, you see this increase in public safety and law enforcement, and most of that increase is due to trying to correct issues in the correction system. One more thing I wanted to mention with respect to the budget, that this is something that Tom alluded to about probably not having enough in the cash reserve. Again, if you look at the Great Recession, FY09, we were at about over 17% revenues in our cash reserve. And Legislative Fiscal Office recommends that we have 16% going into a recession. Tom showed that chart that showed the cycles, and he talked about there being a 5-year cycle of above and below. And so based on, or a 4-year cycle, I guess, based on those cycles, they recommend having about 16% in the cash reserve. The local Government Finance Officers Association recommends 2 months, which is 16.7%. In any case, we were above that level going into the Great Recession. Unfortunately, we're going to be at about 10% this year, and that assumes that the emergency funding that the legislature appropriated to the governor's emergency response fund for COVID, we assume that gets backfilled with the CARES funding from the federal government. If so, that number goes to about 510 million. And then in the next biennium, there is a planned usage of funding for the capital construction project, which would take it down to 455 million, which puts us at about 8%. So about half of where we want to be in a recession. So Tom alluded to that we may not have as much as we would like in the cash reserve, and this is what he was referring to. Any questions before we start talking some taxes?
Yeah, in my notes yesterday, this is Helen, I'm sorry.
Yeah.
I had a higher percentage of the revenue going to education. And so I was surprised when you said it was 45%. And so I just wondered, maybe I misunderstood yesterday, or are there different metrics that people are using?
I'm not, Connie, do you know? Otherwise I can look, Helen, I can take a look back at Tom's slides and see if I can figure out what the difference was and report back later.
Yeah, somewhere he said 64% was going to TOSA. So
no, I don't think that's correct.
Okay.
We're not even
property tax would be about 60.
But I think he wasn't even talking about property tax. He was just talking about state funds.
I
Didn't
think
you have that impression yesterday?
I think, and we can look back at this, but I think he might have been referring to the budget increases
that's right.
Biennium over biennium. So
he did definitely have that in his charts. Okay, moving on. Thank you. Though.
Yep, that's right. We'll go back and see if we can pinpoint exactly where that is, Helen. But yeah, he did talk about the bulk of the increases over that time going to TOSA.
Okay.
That's right. So So Tom also alluded to three-legged stool. I can't remember exactly what he referred to it as, but sometimes people will call property taxes, income taxes, sales taxes a three-legged stool. So this version, when he was showing you property or sales and income taxes, is just general fund sales taxes. So this would be all sales taxes that are collected at the state level, since we're looking at state and local. So property taxes are a completely local tax, but they're the longest leg of this three-legged stool, which with 38% of state and local taxes coming from the property tax, followed by sales tax, which is 29.6. So that would be our general fund sales taxes, as well as local option sales taxes. There are some other sales taxes like turnback taxes that would be included in there that are collected at the state level but actually don't go to the general fund. It includes selective sales taxes such as cigarette taxes and gas taxes. And then our income tax, corporate and personal, would be 25.4%. And then other is our small little leg at 6.81%. And that would be motor vehicle taxes, inheritance taxes, hunting and fishing fees, that sort of thing. Excuse me. So when there's conversations, sometimes we don't necessarily advocate for balancing the three-legged stool, but to put in perspective for you, if we wanted to have equal levels of property sales and income taxes, you'd have to cut property taxes by 700 million. You'd have to raise sales taxes by 147 million, and you'd have to raise income taxes by 556 million. Again, we're not advocating for this, but we're just trying to illustrate that when it comes to having a conversation about reducing property taxes, that either we're looking at making outright cuts or some sort of tax shift, and it's pretty daunting with those numbers. So in terms of property taxes, the big thing that I just want to touch on here is that real property is taxed and assessed at 100% of market value, except for agricultural and horticultural land, which is assessed at 75% of market value. Personal property of businesses is taxed, although there is an exemption for the first $10,000 of tangible personal property for each tax district in which personal property tax return is filed. And then we don't tax things, intangible property like stocks and bonds or personal property. And then there are some property for certain educational, religious, charitable organizations, which would be exempted from property taxes. The property tax varies by locality, and as I said, raises more money than any state tax. The statewide average property tax rate is $1.68 per $100 of property value, but it ranges from 75 cents to $2.31. So there's quite a range there depending on where you live. There are some levy limits. Connie will talk about these a little bit more. There's a $1.05 levy limit for school districts. Cities and counties also have a levy limit at 50 cents. And then there are some other levy limits for smaller government entities like NRDs and community colleges. And all of these levy limits can be overridden by a vote of the people. In terms of income taxes, my mouse is getting stuck. What I want to just touch base on income taxes, we do not have a flat tax. We do have a progressive income tax, which means the more income that you have, the higher your tax rate is. We do hear often that someone who's making $32,000 pays the same top rate as someone who's making $1 million. And that's not totally accurate. So I do want to walk you through that. So the way that our income tax works is that you actually pay that tax rate by bracket. So your first $6,440 of income, if you're married filing jointly, is going to be taxed at that lower bracket rate of 2.41%, with a couple caveats that I'll get to in a minute. And then the next income between 6,400 and 38,000 is taxed at 3.51%. And then it goes on, and then your income over 62,320 is taxed at that top rate of 6.84%. But there are a couple of caveats. So with the Tax Cut and Jobs Act at the federal level, that broadened or increased the standard deduction, and that was increased at the state level too. So the standard deduction is $13,800 for a married couple, or $6,900 for an individual. So if you opt to take the standard deduction, your first $13,800 isn't going to be taxed. So it's only your income above that then is subject to those 4 tax brackets. You also receive a personal exemption credit, which is $137 per exemption or per person dependent in your household. So I'm going to go back to that slide. So again, you would have to take the 13,800, and so if you're making about 75,000, right? You're not going to be paying any of your income at that 6.84%. It's only going to be the income above that that is taxed at the top rate of 6.84%. So that's just something that we hear people saying a lot, and I just wanted to clarify that, correct that misunderstanding that a lot of people have. So you can either take the standard deduction, and more people are opting to take the standard deduction now that it's higher, or you can file for itemized deductions. The biggest itemized deductions are for charitable giving, medical expenses, state and local taxes like your property tax. That's also known as the SALT deduction, which there's a lot of conversation about at the federal level, and there's some others, but those are the big ones. So the deduction will reduce how much income is subject to taxation. So again, if you fall into the 6.84% bracket, $1,000 deduction saves you $68.40. Whereas a credit like the personal exemption credit or child care tax credit or EITC are a dollar for dollar reduction of tax liability. So $1,000 tax credit saves you $1,000. Okay. So Rick, I know that you're interested in military retirement. Right now, the way that we have a partial exemption for taxes on military retirement income, you can either opt for an exemption of 40% for 7 consecutive years, beginning the year the election's made, or 15% for all taxable years, beginning with the year in which you turn 67. There is a piece of legislation that's out on final reading right now, which would remove this exemption and replace it for 50% exemption for military retirement income period. That comes with the fiscal note of about 12 million, 13 million a year. And as you probably saw, the speaker said in the paper that anything with the fiscal note is going to have a difficult hill to climb. And so people should look for ways to minimize that fiscal note. What Tom alluded to yesterday that you may see with some of these bills is postponing the effective date, putting that into a following biennium. We always get concerned with delayed effective dates. If we can't afford it now, how do we know that we'll be able to afford it 2 years from now? But that may be what they end up doing with some of those bills that are out there that have some fiscal impact. With Social Security, taxpayers do not pay state income taxes on Social Security benefits if they are married with AGI under 58,000 in Nebraska, or a single taxpayer with income under 43,000, and then it ratchets up from there. and so that no one is taxed more than 85% of their benefits. Tom did talk about indexing yesterday. The Social Security tax is going to be, or Social Security exemption, excuse me, is going to be indexed to inflation beginning this year. So with the credits and deductions that are available, we end up paying a lower effective tax rate than our marginal rate. So again, our top marginal rate is 6.84%, but the effective tax rate, which is the rate that we actually pay in taxes, is less than that. So for the first, the 70% of taxpayers on the lower end of the income scale have an effective tax rate of 1.76%. This information comes from the Department of Revenue, and unfortunately, they just lump 70% of people together to give us that 1.76% effective tax rate. And then the 10% of the wealthiest Nebraskans pay an effective tax rate of 4.81%. And then the wealthiest 500 families pay a effective tax rate of 3.53%. The Department of Revenue, this is in a tax burden study. Well, we have a link on the last slide, so you can go to that report if you're interested, but they do assume, or they believe that the reason that the top 500 families have a lower effective tax rate is largely due to incentive policy in Nebraska. In terms of corporate income taxes, I'm not going to go into too much depth, but the brackets are different. There's only 2 brackets, and income 0 to 100,000 is taxed at 5.58%, and then at over 100,000, it's again 5.58% on the first 100,000, and then 7.81% on income in excess of 100,000. And unfortunately, there's not as much data about corporate income taxes in Nebraska as there are on personal income. So sometimes it's a little bit hard to know exactly how much corporations are paying and that sort of thing. So in terms of sales taxes, our sales tax rate is 5.5% with up to 2% additional local option sales tax. 238 local jurisdictions utilize that local option as of July of last year. So in Nebraska, we tax goods and some services, and we don't tax a number of services and groceries and business inputs. Business input, you don't want to tax because it creates pyramiding. So for example, if you think about the chair you're sitting on, you don't want to tax the fabric and the cushion and everything going into that chair. You just want to tax the chair at the time of sale so that you don't have pyramiding of taxation and the cost of making that chair. Where we think that there is an opportunity for a broader sales tax base is really looking at services. Nebraska taxes 81 out of 176 services taxed in other states. The Institute on Taxation and Economic Policy has estimated for us that we lose about $178 million in annual revenue due to untaxed consumer services. And then I would just flag that there is 1/4% of the sales tax that is diverted. It used to go to the general fund, but now it goes to the State Highway Capital Improvement Fund, and that reduces general fund revenue by approximately $83 million in FY19. So Tom alluded to, he mentioned about the income tax growing a lot faster than the sales tax. So I do want to talk about this briefly. You can see that gray line are services, and then the blue line is our typical sales tax base. And what's happened is that we are spending more and more of our household income on services and less of our household income on our typical sales tax base. As a result, our sales tax isn't growing as fast. So, and I did have a slide in here that I ended up taking out, but I do want to mention it, and it does show, again, that our income tax, and Tom mentioned this, our income tax does grow faster than our sales tax. And what we saw during the Great Recession was a lag in our income tax. So it did take a dip sort of a year later, which we would expect to see, as I mentioned earlier, that our income taxes this year are based on last year's income, right? So when we're looking at 15% unemployment, our 2021 income taxes that are based on the year 2020, we would expect to see those down pretty significantly. Really quickly, I want to just mention the gas tax. I'm not going to go through all of this, but this wholesale tax rate is going to probably cause a problem for state and local governments because it's based on the average wholesale cost of fuel in the prior 6 months. So again, right now, our wholesale tax rate is based on last year, the second half of last year. So once we get to July and we're looking at the wholesale rate for this year, our wholesale tax, or looking at the cost of gas, cost of fuel in the first half of this year. So the second half of this year, the fall and winter that wholesale tax rate is going to drop. And it's probably also going to be down pretty significantly than the first half of next year. So that's going to have a negative impact on the state and on city and county governments because that wholesale rate. So without the legislature doing anything, there's going to be a big drop. And that's not even changing how much people are driving, which will also be impacted. All of these gas tax rates will be impacted, but the wholesale rate, even if people were driving the same amount, because the cost of gas has gone down, that wholesale rate is going to go down and bring in less revenue for state and local governments. Just wanted to show this to you in case you're interested. Generally, Nebraska's taxes tend to be about in the middle in every across the board. A couple where we're low, you can see here, liquor, we're 39, cigarette tax, we're 41st, but I'm not going to go into depth in these. We do have an inheritance tax in Nebraska. We used to have an estate tax, but got rid of that, I think, over 10 years ago. But we do have an inheritance tax. This tax does go to counties, and a lot of counties do use it to try to keep their property taxes down, but it averages significantly. You can see it averaged between $74 in Arthur County in FY18 to $16 million in Douglas County, but the average county revenue is $757,000. The median county revenue is $353,000. So really briefly, there's a lot of talk about state tax expenditure, and a tax expenditure is an exemption, deduction, credit, exclusion, or other deviation from a normal tax structure. And so once we pass a tax expenditure, so for example, the military retirement exemption would be considered a tax expenditure because it's a deviation from a normal tax code that would tax all income. So once that's passed, it's spending that goes through the tax code, so it's not reviewed. It's just revenue that's coming off the top rather than it being something that needs to go through the appropriations process every 2 years. So there is a tax expenditure report that we've linked to here that the Department of Revenue puts out, and there is a hearing that is before the Revenue and Appropriations committees prior to December 1 of every year, where they have an opportunity to ask questions about the tax expenditure report and the revenue that the legislature has purposely decided to forego. And just to give you an idea, based on the Department of Revenue's tax expenditure report, we're foregoing about $7 billion. Most of those in sales tax exemptions, but also a lot in income tax exemptions. I would note here, our number for untaxed services was lower. Our number was just consumer services. These untaxed services in the Department of Revenue report include professional services, which would have some business to business services and things like attorney's fees and accounting fees and that sort of thing. But we do believe that it's really important for the legislature to review these exemptions when we're talking about a significant amount of revenue, just to make sure that they're still good tax policy. So how do we compare? As I mentioned, we tend to rank about in the middle on most taxes. And you can see here, depending on whether we look at our ranking per capita or per share of GDP, we're 16th to 29th. So depending on what measure you use, there's a pretty big range. What I think is sort of interesting is that we actually rank lower when it comes to state and local spending than we rank on taxes. The thought on that, the reason that we rank lower in spending is because we rank lower on the amount of revenue we receive from the federal government. So then our state tax revenue actually has to work, a state and local revenue has to work harder. So again, you can see we tend to rank about in the middle. Property taxes where we rank the highest from 11th to 13th. And then our tax code is regressive, which means lower income families pay a higher percentage of their income in taxes than higher income families. Most states have a regressive tax code, so we're not unusual in that respect. But you can see here that our sales tax, that's the yellow bar. So the gray bar is our total state and local taxes. So the poorest 20% pay about 11% of their income in taxes, whereas the wealthiest 1% pay about 8.7. But then you can see the yellow bar, the sales tax is the most regressive. And then income tax is the progressive tax, which I mentioned earlier. So high income families pay a higher percentage of their income in income taxes, and then property taxes are regressive on the ends and then proportional in the middle. So I know I blew through that really quickly, a lot of information, but I wanted to get to some of the current policy issues. So Tom mentioned, didn't spend a lot of time talking about the budget challenges yesterday. I don't know if you noticed, he had a big $500 million revenue loss from COVID-19. Moody's Analytics is projecting that the best case scenario for states is about a 10% revenue loss, which would be about $500 million a year. So what Tom presented yesterday was best case scenario. And that his numbers that he presented have a pretty quick recovery. We're a little more skeptical about having a quick recovery, but again, that's, you know, best case scenario. We're able to get through it with the cash reserve, but based on what happened with the Great Recession, we believe that this recovery is going to be probably a little bit longer than what they're planning for. And going into COVID-19, we had a depressed ag economy and tariff issues. So we were already seeing, farmers struggling with income, and then flooding and disaster recovery. So this is just coming on top of a couple of pretty big hits. The Legislative Fiscal Office puts together a sheet that shows tax changes since 2006, and those collectively have reduced revenue by over $900 million in FY20 alone. So there are a lot of tax changes that have passed that have been reducing revenue. We've got tax incentives that Craig will talk to briefly in a bit, but those have spiked in a few years that have contributed to some budget challenges that the legislature is facing. Talked a little bit about services. Not taxing services has slowed the growth in that sales tax and sales tax revenue. And then we've also had some revenue fluctuations due to federal tax changes, which has made predicting state revenue, because we're so highly coupled to the federal tax code, has made that a little bit more challenging. So the main discussions for the remaining 2020 session are going to be when they come back for those 17 days. I think there will probably be a lot of conversation about priorities relative to COVID. So public health, as you heard Pat talk about, we're going to talk about unemployment a little bit later. Obviously, we're seeing unprecedented unemployment claims. We had a fairly robust trust fund, unemployment insurance trust fund going into this that we could certainly blow through pretty quickly. Medicaid, the Medicaid expansion is supposed to be implemented October 1, and then SNAP, which is food support. Then we've got the current biennial budget. So as Tom said, we're in the middle of a biennium. So the biennial budget has already passed for this 2-year. So we're in the first year of the biennium, and then the second fiscal year of the biennium starts on July 1. And so any revenue, if we are projecting that we're going to have less revenue than the budget had been based on, the legislature will have to make mid-biennial budget cuts, which are really difficult because, for example, like schools, they've already hired teachers for the fall, right? And so a lot of these agencies have already planned for these expenses. So it's very difficult to do mid-biennium to make those budget cuts. So that will be something that the legislature will need to talk about when they come back in July, but it also may be something that the legislature is talking about in January. And what Appropriations Chair Stinner has said is it's quite possible that the legislature actually has to do 2 budgets in January. The first one being any changes and reductions that need to be made or moving things around in the current biennial budget, and then planning for the following biennial budget. Then you have the federal funding from the CARES Act, which is over $1 billion that has come to the state of Nebraska. This was something that Tom alluded to as well, but I'm not sure if it was clear what he was referring to. He talked about how there is a statute that has appropriated federal funds already. The legislature could opt to change that language so that the legislature was in control of spending the CARES funding, or they could do something that's sort of in the middle. But there is over $1 billion there. Representative Bacon is trying to bring forward an amendment that would make that CARES funding, the Coronavirus Relief Fund, is specifically what comes to the states, make that more flexible so that could be used for backfilling revenue. So that there's a big pot of money sitting out there, and it remains to be seen yet as to how that will be spent and who has the authority to decide how that's spent. So my guess is that will come up in that 17-day session. Then you have the University Next project, which is LB 1084. This is the big expansion of their biocontainment unit dealing with infectious disease. So obviously it's extremely timely. It would take quite a bit of time to build that, but it's a $300 million project. And the last time I looked, it had 32 co-sponsors and needs 33 senators to get it across the aisle. So, or across the finish line. So, but again, it had those 32 co-sponsors before when we had a projected revenue surplus, which is a situation we're not in any longer. Property tax reductions, Senator Linehan and the Revenue Committee have LB 1106. So at this point, the question, and Connie will talk about this more in depth in just a few minutes, will they pass 1106 or something different than that, or nothing at all? The price tag on LB 1106 is $519 million over the next 3 years. And so, which was actually more than the projected surplus prior coming into this pandemic. And certainly that surplus has been wiped out. So again, I think that there's a big question as to where that revenue would come from. So this is still an ongoing discussion that legislators are having right now. There had been a ballot initiative that you're probably aware of that would have reduced property taxes, created a refundable income taxes against your property tax paid, which was suspended. And then Craig will talk about tax incentives, with our big tax incentive program expiring at the end of this year.
Okay, thank you. So as Renee mentioned, tax incentives are business subsidies that are given to businesses that typically seek to increase investment and employment. Nebraska has several programs, and the largest, which is Nebraska Advantage, offers companies sales tax exemptions, income tax credits, and personal property tax exemptions. The Advantage Act became law in 2005 and has since reduced revenue to the state and local governments by an estimated $881 million through 2018. As Renee mentioned, it is scheduled to sunset at the end of this year, but with the way Advantage is structured, it could allow companies currently participating to continue receiving benefits until 2040 or 2050, as contracts under the program can last up to 30 years. By 2028, the Department of Revenue estimates that Nebraska Advantage will have been a net revenue loss to the state of over $1.5 billion, and that is even when accounting for the increased investment and employment that is attributed to the program. So the precursor to Nebraska Advantage, which was called LB 775, was passed in 1987 and it sunset in 2005. That program has amounted to foregone revenue in excess of $3.1 billion, with over 40% of that 3.1 billion having occurred after the program sunset. Active LB 775 agreements will remain until 2025, which again is 20 years after the program sunset. Next slide, please. Thank you. So also, as Renee mentioned, the legislature is debating a replacement for the Advantage Act. LB 720, which is also known as the Imagine Nebraska Act, was introduced during the 2019 session, where it failed to advance from select file. The proposal was brought back during the 2020 session with an amendment and is currently still sitting on select file. The proposal is pretty similar to the Nebraska Advantage Act in that it provides sales tax exemptions, personal property tax abatements, and tax credits. If LB 720 fails to advance this year, policymakers will have two options. They can either extend the Nebraska Advantage Act an additional year with a bill that was introduced this session, or they can let the Nebraska Advantage Act expire. They can let its sunset actually happen. There is one item that we want to bring to your attention should LB 720 pass or Nebraska Advantage be extended. And that is that if 2020 is the year that companies base their employment and investment on for those future increases that they have to meet in order to get those incentives, it has the potential to incentivize companies to lay off people so they are subsidized by the state to rehire those employees under the tax incentive that they would have hired back anyway when the economy does get better. So with that very brief tax incentive discussion, I will turn it back over to Renee.
So here are some resources, and we'll be sending you the PowerPoint, so you'll have the ability to access these links if you want to look at these further. And I did a good job of getting us behind already, but if you have any questions, we have a couple minutes or we'll have time later. Any questions? No? All right. So we will turn it over to Connie to dig right into TIOSA or K-12 funding system. Connie.
Okay, my presentation is called TIOSA 101. And before we get started with TIOSA 101, I thought I would give you a little bit of